Good afternoon. My name is Dave Rodriguez. I'm the head of Blockworks Advisory. And today we're going to be talking about building robust financial markets on-chain. The old adage of institutions are coming, in my opinion, is outdated. Institutions are here. Every single institution worth their salt is thinking about their digital asset strategy, thinking about tokenization and stablecoins. And tokenized asset value on-chain is seeing hockey stick growth, up over 100% year over year to over $34 billion in on-chain asset value. We've moved away from the theoretical of tokenization of assets, of tokenizing money market funds. What if we did that? What if we tokenized debt? What if we tokenized equity? We actually have some panelists on stage today that have really pioneered this fast-growing vertical. And I'm really excited to hear their thoughts on how's the shifting regulatory landscape today impacting like the catalytic growth that we've seen over the past couple of years? What are the different strategies that they're deploying to tokenizing equity and debt? What is the next stage of tokenizing beyond debt assets? And also, what does the next 5 to 10 years look like of this, growing vertical? So with that being said, I'm going to ask my panelists to give brief introductions before we kick off the rest of the panel. Sandy, I'll start with you, and then we can work our way here.
Great. Hi, guys. Sandy Kaul with Franklin Templeton. I head up our innovation team, including our digital assets unit. Happy to be here today.
Hi, I'm Alex Prager. I'm the head of product for Connexus Digital Assets at JP Morgan. Connexus is JP Morgan's blockchain-based unit.
Hi, good afternoon. I'm Jeremy Ng. I'm the founder and CEO of OpenEden. OpenEden is an end-to-end regulated tokenization platform. So we tokenize US Treasuries. We've created stablecoin that's backed by tokenized Treasuries. And we're happy to be here as well.
Brett Hillis, partner at Reed Smith Law Firm in London. Practiced in the digital assets area for about 10 years. Particularly in terms of tokenization, I've worked on tokenization of commodities, loans, debt, all sorts of products, both on the regulatory and the sort of transactional structuring side. Great to be here.
Awesome. Thank you, guys. So just to kick off the rest of the conversation, I want to open up a question for the entire panel. Why is this time different? Has there been a certain point in time over the past maybe 2, 3 years where your clients, your customers, even the regulatory bodies that you deal with really opened up their eyes and started taking tokenization and on-chain markets more generally seriously?
I'll jump in and start. Yeah. I think this time is different for 3 reasons, right? Number one, there has been a change in administration in the US, and the Trump administration is far friendlier to crypto and is willing to push the boundaries on rulemaking faster than the Biden administration was willing to do so, we'll say nicely. I think secondly, we saw the passage of the Genius Act in the US and the implementation of MiCA this year, both of which have started to give some regulatory certainty. And with the Genius Act in particular, it's legitimizing the cash layer for the new liquidity of the system, which you can't have a system without liquidity. So this is giving people confidence now that we will see that liquidity layer grow with big banks coming in and with others coming into the space. And then I think the third reason it's different this time is because there is starting to be greater and greater acceptance that digital assets are part of a portfolio exposure. The wealth networks are now approaching, the point where they have seen Bitcoin and other ETFs and crypto in operation for close to 2 years. They're seeing that there hasn't been big blow-ups, big issues. It's giving them confidence, and they're feeling increasing pressure from their own clients to not just make this available on a reverse solicitation basis, but to actually start to make this part of a regular set of portfolio advice. So I think it's those combinations of regulatory pressure and acceptance, new ability to count on the liquidity layer in the marketplace, and then growing customer demand.
Got it.
Yeah. I think the big... Oh, go ahead.
I mean, clearly the regulatory part, plays a very important part. So I think what I would touch on is utility. Why is it different now? Because tokenized RWA has gained greater composability and utilities in addition to simply just holding it as an investment product. So for example, if you look at exchanges, they're now opening up to accepting tokenized RWA. For example, OpenEden's USDO as a accepted collateral. And the way they structure that is allowing institutional investors to hold this yield-bearing collateral off exchange. And the exchange will allow you to have a mirror asset for them to use as a collateral. So I think, in addition to obviously the way that the product is being structured is a lot more regulatory compliant and whatnot, but giving them utilities through these products, either on CeFi or on DeFi, is propelling the adoption and propelling especially institutions coming in to use them.
Yeah, completely agree. I think on my side, the regulatory clarity, as already pointed out, has been huge. I think it's something in the US we've been waiting for quite some time. And so that has really allowed us to continue forward at a faster pace than we have been in the past. I think also the, emerging, growing product market fit of everything that is out there right now is a driving factor behind, I think, the increase in activity that we're seeing, and those things coming together, really make this time different.
Got it. Brett, I want to double click on your expertise being in like the legal space for digital assets. How are you seeing the diverging, handling of regulations between like the UK, the EU, and the US? Like, how are those diverging approaches to how they're handling digital assets, impacting the development of tokenized assets, at least maybe in the jurisdictions you're aware of?
So this is something I'm kind of more relaxed about than I might have expected. Okay. So certainly in the UK and Europe, probably the key factor is that if a product's already regulated as a kind of financial instrument or kind of investment, then if it's tokenized, the standards are pretty much the same. So you're not in a situation where you're suddenly facing an additional sort of set of hurdles. So the way the regulator is looking at it is technology neutral, or trying to be technology neutral, looking at sort of specific issues. So we're expecting in the UK a fund tokenization paper from the FCA looking at kind of how they're going to take that forwards tomorrow. And for that, we're expecting something, as I said, technology neutral and pretty straightforward. Now, for more, I suppose the more inventive products are commodities. There's going to be more issues, but certainly for the more traditional kind of investment products and their tokenization, I don't see the regulatory divergence as being as big an issue. And obviously, any divergence can increase costs, but because of the attitude, it's less of an issue than it may have otherwise been.
Got it. I want to double click into building on-chain debt markets. So Sandy, Franklin Templeton's pretty much was one of the early pioneers of this with your Benji tokenized money market fund, I believe launching in 2019 or 2021, actually, you told me right before. What does tokenization actually enable Franklin Templeton that you couldn't before? And also, how are you handling daily yield generation? What are some equity-like properties that now you can apply to tokenized debt that you really couldn't in the traditional sense?
Yeah, so we launched our tokenized money market fund in April of 2021. Franklin Templeton is a little different in that we are not running a digital twin. Like our tokenized money market fund, the token is the digitally native exposure. And therefore, we're able to do some things with our tokenized money market fund that is not possible for many of the other products in the market that are still digital twins. For example, we can settle our shareholder record second by second. So every transaction that occurs settles immediately upon that transaction being added to the block. The payments and the securities are exchanged, and you are actually credited as becoming a shareholder the second a transaction settles. And since we're accumulating the shareholder record in a second-by-second manner, we're able to pay intraday yield. So if you just held our money market fund for an hour and 15 minutes, you will get an hour and 15 minutes worth of yield. That's just something that's not possible today with the way that money market funds trade. The other thing that we're able to do is we're able to pay out that yield every single calendar day of the year, including including Saturdays, Sundays, and holidays. And that yield is paid out in incremental new issuance of tokens dropped directly into your wallet. So this is a daily yield product, and it's paid out daily, whereas most money market funds today accumulate that yield for a month before they pay it out. right? So we're able, because we're running natively on blockchain, to enable these new use cases. And we're going to be enabling that for any tokenized real world asset. So tokenized equities are coming, tokenized bonds are coming. Because the smart contracts in these assets are programmable, all of the middle office operational tasks that today don't get kicked off until after the close of the trading day and the settlement of the security, right? Today, we're able to kick those processes off the minute a transaction occurs on chain. And so we're cutting out entire layers of operational risk by moving our infrastructure onto blockchain and being able to deliver our entire set of middle office functions via the smart contracts. And that's really, I think, the benefit and the potential in this space is that those assets become much more transferable. We already enable peer-to-peer wallet transfers and self-custody. You start to be able to use them in many more use cases. We can use them in DeFi use cases. You can use them in collateral mirroring use cases, right? And these are regulated financial products, so there's also a degree of consumer protections to them that translates into the web-based, into the chain-based environment. So I think that building natively on chain does give you some real advantages in thinking about how the future state financial market infrastructure is going to operate.
Awesome. Jeremy, I want to click on you because your OpenEden's T-bill product is really setting the standard for audited transparency. I believe like a week or two ago, the S&P gave your T-bill product an AA+ rating, so kudos on that. Want to like learn from you, how do you ensure robustness during market downturns, and also what are some TradFi lessons that you're applying on chain to ensure from like a risk management perspective everything is okay?
Yeah, that's a very good question. I think while we see a huge proliferation of out-of-base products, I think one thing that we need to be aware of and remind ourselves is that not all out-of-base products are created the same. And one thing that I remember very clearly is back in my TradFi days, when the global financial crisis happened, now, I personally owned some Lehman-issued structured notes. And even though the underlying some blue chip equities that actually still has value, but because of what happened to Lehman being insolvent, all the senior secured, unsecured debt, including the structured notes that they issue, will be trading just exactly like the Lehman bond, which is down 80%, 85%. So it doesn't matter what is your underlying. Now, compared to the SPV repacked that Lehman Brothers has issued, essentially using a bankruptcy remote vehicle and to repack whatever is the underlying asset. Now, those products continue to perform in accordance to exactly what the underlying assets are trading. So kind of bring that back to RWA is very important that how you structure the issuance vehicle can either add a lot of counterparty risk or can reduce or at least eliminate, right? So I think it's really important that over here, we hear Franklin Templeton, OpenEden, our products are all regulated, are all issued, through licensed entity, and I think that really kind of sets the difference between a lot of the other out-of-base products that are issued, just through some LLC or some, limited, private limited company that is either not regulated or not structured in a way that is bankruptcy remote, meaning that the asset liabilities are completely ring-fenced. So I would say that, apart from being transparent, the legal structuring of the issuance is critical.
Got it. So, I mean, that's a great segue for a question I have for you, Brett. So from a legal perspective, what kind of structures like trusts are essential to make sure that they're enforceable, especially in cross-border scenarios?
So as a sort of English lawyer, a sort of, practicing kind of common law, we're not in a situation where, like, I've got a hammer, so everything looks like a nail. I mean, you've got so many different kind of options and kind of techniques that you can use. But the trust probably is one of the kind of absolute sort of key ones around kind of bankruptcy remoteness, limited recourse, and kind of those sorts of structures and facilities to kind of put them in place to actually create something that's robust. It's not the only way to do these things, but certainly, like a lot of the structures we've worked on in the tokenization space to kind of provide that bankruptcy remoteness are based on trust. So that's a key one. You can see other structures based on loan based, but certainly the trust is the kind of most common one, and it really is a structure where sort of English law, most US law, and sort of a lot of the laws around some of the sort of UK kind of territories, Cayman Islands, they all use the trust kind of mechanism. And in a lot of other jurisdictions, you don't quite have the same toolkit. So that's certainly one that in a lot of the structures that we work in, it's kind of absolutely key.
Got it. Great. So moving on to tokenized equity and expanding accessibility. So Alexandra, I want to ask you, how is Connexus addressing identity and privacy to make equity tokenization viable for commercial real estate and other types of illiquid assets?
Yeah, so privacy and identity for us have been paramount for quite some time, and we've been looking at the two together and apart for a number of years now. So from an identity standpoint, we have developed our own SSI SDK. We've open sourced it in the past and have been looking at verifiable credentials for upwards of 5 years now. I think on the actual implementation and scalability part, we still have a ways to go. I think there's a need for industry standards and frameworks that the ecosystem can adopt so that it's able to actually scale in a way that would be extremely meaningful for the market. Identity is something that is extremely important in the market today, right, for existing instruments. So it's the same when we think about one of the kind of parameters to truly scaling on-chain activity. I think identity and privacy as well, they won't be the first thing solved because we need to first get market adoption, utility, and activity. I think that is the first order of business. And then once we have that, the privacy and the identity components, I think, become even more important. From an identity perspective, we did Project Guardian in 2022 with the Monetary Authority of Singapore, looking at institutional DeFi and being able to actually authenticate a trader's identity and credentials before completing a trade. So early on have seen the need and the value of that for on-chain activity. And then from a privacy standpoint, last year we did Project Epic. So not only my favorite project name to date, but it's enterprise privacy, identity, and composability. And so really the need for privacy preserving identity on-chain and reusable identity on-chain is something that will make onboarding way more efficient. It'll make secondary trading way more efficient. And so both identity and privacy, I think, are two of the key unlocks to really having scalable long-term activity on-chain.
Got it. Sandy, so I've listened to a couple of your talks before. I know you've spoken about how tokenization transforms equity markets. Recently, I think relatively recently, Franklin Templeton partnered with Binance to, I guess, offer more accessibility for tokenized assets. And I want to know, like, from Franklin Templeton's perspective, what additional beyond debt assets are you really excited about, and what are you looking into?
Yeah, so look, we have an overarching thesis that we are moving out of an account-based world and into a wallet-based world. And that every asset we own, right, from every investment asset we own to every monetary asset we own to our key identification documents, to Alex's point, right, that all of that is going to sit in our wallet. And once all of those assets are in a wallet, the way that you optimize and manage and utilize every asset in that wallet to its utmost becomes what differentiates service in the future, right? So in that pursuit, we need to really get closer to people who operate every day in a wallet-based environment, right? We are in traditional finance. We are part of the account-based world, so we need to be closer to the wallet-based world. So that is why we made this partnership with Binance. Binance is one of the largest providers in the world. They have nearly 300 million wallets. And this is a chance for us to really engage that audience and start to really understand their behavior, their needs, and be able to model and adapt our products for this wallet-based environment. And so, when we think about what tokenization of equities and what other new assets go into that wallet, I think that there will be a progression, right? We're already starting to see these kind of derivative-like equity products from offerings like Robinhood and Kraken, where they're putting the equities into a trust and then they're tokenizing access to the trust. I think that's a great first step. Then I think you get to digital twins. There's already some talk about NASDAQ and others looking at the digital twins, which is I lock the shares up in an account and then I issue a token on top of those shares that are locked into custody, which is great. So now you're one step closer. I think that the end point is really issuing equities natively on chain. And once you're issuing equities and you're issuing securities, not just equities, but bonds and other securities natively on chain, that is when you start to really find the full utility of the rails. And so I think that we will speed through that progression much faster than people anticipate, right? It would surprise me if it's going to be more than 18 months before we go from this first stage, which is, the tokenization of things in a trust, which is a derivative, to full canonical equities. And that's what's going to unlock all of the lending use cases, all of the collateral use cases. That's what's really going to create the utility that makes it more attractive and to be in the wallet-based system than in the account-based system. So these are all, I think, very necessary steps on the way. And that vision of what that future wallet is going to hold and what it's going to be able to accomplish, it's so compelling, right, that it's such a step change improvement over what's possible today for the majority of the world's investors, that the pressure to move fast and get there, I think, is going to be extreme.
In a wallet-based world, especially where you're offering tokenized assets to 300 million plus Binance users, just as an example, is there anything that's at odds with like providing equitable access to these tokenized products and like a compliance perspective? Like, are we at odds? How do we ensure that we maintain the compliance required from like a TradFi perspective, while also providing equitable access to, people all across the world for these types of products? Really open question for all. If anyone like has a thought on this.
I'll start. I mean, it goes back to the stuff that Alex was talking about, right? Is that there are new technologies and new solutions for how identity operates on chain. Sure. There's new technologies like zero-knowledge proofs. There's new abilities to issue soul-bound tokens. There's new abilities to link identity to the wallet, not to the transaction. Right? We already have white-listed wallets, which is what is allowing regulated players like Franklin Templeton to operate in the public blockchain ecosystem. So I think that we're already on the pathway to devising the right solutions that will be able people to preserve, as you said, a sense of privacy, but also give enough information to the underlying institution that they can reliably trade with that entity.
Got it. Anyone want to? We can move on if anyone wants to add anything.
Sitting at a bank, it's something we think about every single day. Not a day goes by without my legal and compliance partners. But, to just kind of echo on Sandy's point and just thinking about identity in general and compliance in general, one of the, I think, biggest hurdles that we've faced in the past is we all know that the technologies are out there in order to make our products compliant. But there's two kind of sides to it. You can either solve first for the compliance piece, but not have any clients or activity, or what we're seeing a lot of now is there's a ton of activity going on chain, right? But we don't necessarily have robust, scalable privacy and identity frameworks in place at large. And so I think it's a balance of both, right? Because if you have this incredible product, but you have no one there to buy it, it almost doesn't matter. And there's, a ton of work going on from a technology standpoint that is continuing to iterate on what we have today from a privacy and identity standpoint. You have, like Sandy mentioned, there's verifiable credentials, there's soul bounds, there's NFTs, there's so many, different ways of creating those compliant solutions. I think what it comes down to as well, and it sounds super boring, but it's, agreed upon standards and frameworks so that these can actually be used and used at scale.
And I think that the sort of the regulators kind of need to be careful about kind of making sure that the way in which they set out the standards are actually technology neutral, and that hasn't always been sort of the case. So kind of part of this work is really around getting them to recognize where there are elements in the current regulations that sort of go beyond the mere kind of protection of identity and kind of ensuring kind of KYC, and that actually it really is neutral.
I think the technology is clearly there, I feel, but a lot of times is the technology is really way ahead of regulatory harmonization. So what I mean by that is, if you look at a couple of the tokenized equities product that is being issued by issuers, being adopted by exchanges, I think all of them are excluding the US. And there must be a reason why they're excluding the US and allowing it to be offered to the rest of the world is they're unsure whether is there proper clarity that this product is acceptable in the US or by the SEC or not. And while we have all this technology to create the ZKs, the soul bounds, as long as there isn't a global standard, which I personally don't think that we're going to ever get to a global standard, it's actually going to be quite difficult to have the operational efficiency that we like, that we, as an issuer, we create a product, we follow a certain rules and expect it to be transported for every single jurisdiction to use it. Unfortunately, that is not the case. And as long as we don't have that harmonization or greater clarity, it is still going to be quite siloed. You're not going to see these kind of products being proliferated in a way that is, you can really kind of confidently say that it's regulatory compliance.
Got it.
Yeah, I mean, so the way to get around that is you launch products in every region that offer the same types of exposure, but they adhere to the different regulatory regimes. So with our tokenized US money market fund, we actually already have 4 actively trading versions of that. We have a US 40 Act version of it. We have a UCITS version of it. We have a private version of it. We have a Singaporean VCC version of it, right? You know, because there's not the global standard, the only option you have in really wanting to operate a global business is to then create the product that each regulatory regime allows and make sure you're in adherence with that regulatory regime. So it will be much easier if they can come up with a global standard, but that shouldn't retard the growth of the ecosystem. And I think that, you know, we shouldn't let that stand in the way as an obstacle to us really growing the amount of product and the amount of and transactional activity that's happening there.
Yeah, I mean, so on that point, it also means that it is a lot more difficult for new players, startups, to do that because we just don't have the scale and the capital of a big asset management company like Franklin Templeton that can issue different products locally because they already have the scale, they have the licenses. Yep. So it's really kind of balance of innovation, speed versus being compliant.
Just to like double click into something, because one of the beautiful things, or at least one of the concepts of tokenization, is that it could allow for like operational efficiencies, especially when you have digitally native assets. I'm kind of asking this question off the cuff, but like if you have to deploy these digitally native or not, if you have to deploy these digital assets jurisdiction by jurisdiction, does it actually negate the operational efficiency that was originally once promised?
I don't think that it does, because some of the operational efficiency relates to these kind of regulatory processes and like so the different things that you have to do to kind of comply with the different wrappers in the US, in Europe, in the UK, and Singapore. So I don't think it negates it. I think it's still valuable. It's valuable in a complex landscape.
Okay. Awesome. Thank you. That was a good one. All right, so moving beyond debt and equity, I want to talk about like new innovations out on the horizon for tokenization. So Jeremy, I'm going to start with you. How do you see tokenized treasuries moving beyond like different RWA asset verticals, and also more specifically about Open Eden's product suite? How are you going to try to optimize yield across different asset classes?
By tokenizing treasuries is really a step one because, first of all, it is the most liquid asset in the world, and it is arguably the safest asset in the world. So for that to be the first product of choice to be tokenized, I think makes a lot of sense. So it's really kind of built the distribution channel, building the recognition, and building the use case. Now, once that building block is done and people can see that it is working, it can be adopted, then adding new product or new asset classes would not be that difficult because you can kind of follow the same model. And at Open Eden, what we do is, yes, we've launched our own products, being an issuer and even investment manager at some point. It was just the beginning. What we really truly want to become is having our platform to be offered to our partners, whether are you an asset owner, asset manager, corporates, or whoever that want to bring their products on-chain. They can come to Open Eden and we can provide a whole suite of white label solutions, including issuance, tokenization, and even distribution. In a way, kind of like an RWA version of Shopify. So I think that's really our vision because we know a lot of asset owners, a lot of even new stablecoin issuers that want to come to the market. They might not necessarily need to build their own tokenization platform, hiring 5, 10 engineers writing smart contract. But they can focus on what they do best. They can focus on the use case. They can focus on distribution. And then we just kind of help them kind of plug and play and very quickly bring to market. So that's really where Open Eden's vision is, and that's where we're building towards.
Got it. Alexandra, how is JP Morgan with Connexus? How are you preparing for tokenized commodities, tokenized FX? We're actually starting to see a little bit of that start to pick up on Solana and a couple other ecosystems. And also, how are you going to ensure interoperability across chains for these tokenized assets?
Yeah, it's a great question. And it comes back to something I think we think about at the core, especially at this point in time. We've been working on the technology for a number of years and have been really focused on getting our infrastructure in place. And with that, knowing which touch points across the ecosystem are going to be important for products and clients. So interoperability, of course, being paramount for that. What I find interesting at this point in time is that the technology, I think, is the easiest part of it. What we're really preparing for when I think about, the next iteration of on-chain products is really clients, their demand, and the use cases that they have. I think the technology, is more known at this time than making sure that our clients are ready and comfortable for whatever on-chain use case that they are looking at. And I think from there, the technology follows. So one of our largest measures of success is really utility and ongoing utility, right? Not 1 or 2 trades and then we're done and we proved that out, but really where is there meaningful long-term utility and activity? And so focusing there first, I think the technology then comes secondary for us.
Got it. Thank you. Sandy.
So I think that, when you think about how it's progressing, right, and Brett has talked a couple times about tokenized commodities, right? You guys are doing tokenized FX, right? These are all starting to be, functions that are very commonly done off-chain, which are now being done on-chain. And I think that's the direction of travel, right? There's so many assets today that are investable, but they're very difficult to create much volume in and difficult to create much liquidity in because there's so many contracts and there's so much operational friction in being able to transfer ownership, right? So even just take something as simple as a painting, right? To transfer ownership of a painting is actually very complex and can sometimes take several weeks to actually complete the transfer of ownership of a painting. Right? You could transfer the ownership of a painting in seconds on-chain. Land titles, right? All of these assets that today, intellectual property, all of these assets are things that people would like to own, but it's very hard to own because there's a lot of operational frictions and therefore there's not a lot of liquidity and therefore the access is very limited. And so we believe that we're moving into a world where many assets are going to become available that can act as their own stores of value, right? There's no reason why I can't use a stable coin to pay for something. I can't use a tokenized commodity to pay for something. I can't use a tokenized money market fund. I might be able to use a tokenized painting, right? Fractional shares. As long as it is custodied by a third party, as long as it's transparent in terms of the pricing and the valuation and the availability, as long as the ownership rights can be cleanly and clearly defined, I can program those assets to become stores of value. And so in many ways, we believe we're moving towards this kind of almost high-tech barter society where all of the options I'm going to have from these different assets in my wallet are going to become, much more, a much broader set of choices. It's almost like today when you go on Amazon and you're buying something on Amazon, they give you your whole drop-down menu. Do you want to use your debit card? Do you want to use your credit card? Do you want to use your loyalty points? I think it's going to be that same concept, but it's going to extend across many, many new types of assets. And if you think about it, as human beings for centuries, we had barter societies. So it's not like this is not precedent for having this. I just think it's going to be a very high-tech barter society.
Awesome, thank you. I know we're coming up on time soon, but I do want to try to ask like 2 more questions if time allows it. So moving to like the forward-looking, like the challenges, the risks, and like forward-looking predictions for tokenized asset class. Regulatory headwinds historically have now turned to tailwinds, at least in like major jurisdictions. But what would you say is like the biggest risk? And this is a really open question to anyone. What is like the biggest risk today to building robust on-chain markets? Is it still regulatory? Especially every regulatory region has its own regulatory body and its own rules. We won't have like one open standard, like Jeremy, you probably alluded to. Is it the fact that we don't even know if there actually is like maybe retail demand? Maybe we know there's institutional demand, maybe not retail demand. Like, what is like that one thing that keeps you up at night building in this vertical and thinking about this vertical?
I think on our side, the one thing that I would say keeps me up at night the most is legacy systems and integrations. I think that those cannot be underestimated in terms of what needs to be done in order to match where we're seeing, on the front end and on-chain efficiencies happening. There's still a lot that is happening back here after execution that I think will take time to fix, and it'll take not 2 years. I think we're looking more out than that. But I do think given the complexity of legacy infrastructure and also how it is different by client set, by asset type, by jurisdiction, anything at all, I think the legacy infrastructure side is one of the biggest hurdles to overcome.
Yeah, for my side, actually, the one thing that I'm most concerned about is investor education, because everybody is kind of jumping on this out-of-date bandwagon. So there are different kinds of issuer coming out to just launch all kinds of out-of-date backed products. And a lot of the investors in the crypto world, they are just chasing after yield. So they look at anything that has the highest yield. They just jump in, but without really knowing what risk they're taking in, either the underlying risk or the counterparty risk. And when things blow up, either fraud or whatever that happens, then a lot of money is lost. And I think that is something that I am most worried about, and not just because they could be competing with us, but it's really that all these kind of failures will lead to lowering of investor confidence and obviously giving a bad reputation to the Web3 world. So I think that is one part that I would like to see more, like, better investor education and proper regulation of, issuers that come out to launch out-of-date products.
Yeah. A lot of the regulatory landmines that you worry about are actually because people have kind of invested and not really understood what they were doing. And then a regulator kind of comes along and tries to deal with that. Right. So it's that kind of almost like regulatory/market failure. It's probably the thing I would worry about most.
Got it.
Yeah.
The final 2 minutes, what I want to ask is brief, concise. What does the next 5 years look like for the tokenized asset class vertical? What are your wildest dreams? What is like a spicy take you have about the tokenized asset class more generally? I'll start, Sandy, with you, and then we'll work our way down.
Yeah, so I think within the next 5 years, you're going to see the widespread introduction of wallets across the entire financial ecosystem, both traditional players and emerging players. I think that you will have kind of a range of product that's being offered, though, there. And that because of the legacy system issues that a lot of the traditional players have, you're probably going to have this kind of digital twin world where things don't operate in real time. They operate on trade date time. And then you'll have this more kind of crypto native world where things are happening in real time. And the question becomes, is that real-time advantage big enough that the pressure builds and you start to see a wholesale transition of assets out of the trade date to the real-time infrastructure? And if I had to lay a bet, I think that's what's going to happen.
I will use my wish list question for the next 5 years, but I do think it is true in certain areas more than others, definitely in the cash side, is more of an abstraction away from the tech I think in 5 years' time, there'll be certain parts of the life cycle that we won't be talking about in as much detail as we talk about today, similar to how I go to a coffee shop today and I pay for my coffee. We don't talk about the amount of, spaghetti that goes through afterwards in terms of payment and which bank it goes into and then which bank, et cetera. So I'd like to see, us move away a bit from talking about the tech specifically and more about the products themselves.
Got it. Jeremy?
Very quickly, I think some intermediaries could be removed. For example, fund administration, because a smart contract effectively can do that job.
Sure. Brett?
Weird and wacky products that and interesting products that we haven't seen kind of on chain before. So things like commodities. I think there's going to be a lot of innovation.
Awesome. All right, guys. Well, that's all the time we have. Thank you for everyone's time. Thank you guys very much. Had a great chat. Enjoy your day. Thank you for coming.